Corporate Finance OneNote Practice Problem. In this presentation, we will work a practice problem in OneNote related to the calculation of free cash flow. Get ready, because it's time to take a stance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we're in the 232 Free Cash Flow section on the Practice Problems tab. Closing this back up, we're going to have our information up top, and then we're going to do our calculation on down below for the free cash flow. So we got the estimated cash flow from operations, the $9,500,000, estimated spending on capital investments, the $6,700,000, estimated dividends on common stock, $680,000, and estimated dividends on preferred stock, then the $430,000. So we're looking for the free cash flow. What's going to be the free cash flow calculation? So we got the estimated cash flow from operations. This is how much we think we're going to have from operations. That's going to be the $9,500,000. Then we're basically going to look at those obligations we believe we might have for the cash flow that we will have from the operation. So cash flow from operations, estimated what we believe the cash flow will be, in essence, from the income statement, or what our cash flow will be, and then we're going to subtract out the obligations that we believe we will have to talk about the free cash flow, the cash flow that in essence we can do what we want with. Obviously, we are restricted if to what the business objective is. In other words, if we're a corporation or management of the corporation, then we are an agent of the owners of the corporation. We're looking to generate revenue within it. So we're going to take a look at our obligations in terms of what cash flow we have to give out in terms of capital expenditures, common stock dividends, and preferred dividends, and then think about the free cash flow we would have to invest in the way we would think would be best to achieve our general objective, which would be the revenue generation. So we're going to take the estimated cash flow from operations and simply subtract out the capital expenditures. Now, capital expenditures would be those kind of investment type of expenditures that we would be making for large investments, things like buying a building or buying equipment. So we're going to think about those types of things in the future, where the amount of the cash flow that we're going to take, put it into large term investments in order to benefit future periods with that investment in like property, plants, and equipment, depreciable assets, PP&E, all the same word, different words for the same thing. Then we might have, when we have to think about how much of that we're going to give out in terms of common stock dividends. We have an obligation to the owners of the company in terms of what those dividends will be. Now, we don't have to give out stock dividends, because you'll recall that the company management can then decide, the board of directors and management can decide whether or not they want to be giving the dividends or retain them in the company. But typically, the company will have some idea of the dividends that they will be giving out based on the cash flow. So we're going to estimate how much of those dividends we're going to be paying out, how much of that cash flow that we estimate we're going to have, we predict we're going to be giving then to the owners of the company in the form of dividends, therefore having less to retain in the company that we can then spend on what we think would be best to achieve the objective of the company, revenue generation. We also then have the preferred dividends, which would be the other dividends that we have to pay out. So we have our obligation. If we're going to pay out dividends, then we have to pay the preferred dividends as well. So that'll be our cash obligation. And then if we subtract that out, the estimated cash flow from operations minus the capital expenditures and the dividends, both preferred and common, we're going to have the free cash flow. That's the cash flow that we can think about doing with what we want. Again, what we want in terms of the objective of the company, in terms of revenue generation objectives.